Welcome to the Vault, where the noise stops and the real money conversation begins. This is not hype. This is not headlines. This is macro, metals, markets, powered by the first ever AI-generated market recap. If you're here for the long game, you're in the right place. Now let's get into it. A massive coordinated grab for physical silver by major banks, coinciding with China's new export controls and collapsing visible inventories, signals a shift from paper price suppression to physical accumulation and a looming repricing of silver. I've analyzed the CME, COMEX, and Shanghai inventory data plus dealer availability to argue that the global silver market is undergoing an unprecedented physical squeeze led by big banks, especially JP Morgan. Historic COMEX delivery and collapsing inventories show a structural physical shortage. In the first two trading days, 3,446 contracts totaling 17.23 million ounces stood for delivery, about 2% of annual mine supply, slashing COMEX registered silver to about 39 million ounces and implying less than 2 weeks of inventory at current drawdown rates. JP Morgan's raid on Deutsche Bank marks a cartel civil war and a pivot from short to long physical silver. Stopper issuer data showed Deutsche Bank forced to deliver about 3 million ounces, while JP Morgan and Citigroup took about 4.4 million ounces. Interpreted as JP Morgan moving metal from for sale to hoarded status and transitioning from suppressing price via shorts to profiting from a future price spike. China's export restrictions and Shanghai backwardation confirm a global, not local, shortage and intensify east-west competition for metal. Shanghai futures exchange inventories dropped 46 tons, 1.5 million ounces, in a day to 681 tons, with spot trading above futures, suggesting panicked industrial buying and a combined New York-Shanghai daily draw of 4.5 million ounces versus 2 million ounces of global mine production. Q is not a banking solvency crisis. JP Morgan's approximately $314 million silver buy is only approximately 0.02% of its Tier 1 capital, but a physical availability crisis in which powerful banks convert fiat into scarce metal, drain exchanges, starve retail supply, sold out dealers, huge premiums, and position for a revaluation toward much higher silver prices, urging individual holders to keep physical silver and ignore short-term paper price dips and sell us your silver campaigns. The silver market moves as a deliberate, well-funded shift by major banks into physical silver amid tightening global supply rather than a mere speculative spike. If you care about silver exposure, track physical availability and premiums, not just the paper spot chart. That concludes today's recap. Catch us next time on The Vaults.